My name is Don Booter. I'm a board member of Naturally Bay Area, and I'd like to welcome all of you to our first Quick Bites session of the year for Naturally Bay Area. As you remember from last year, these are lunchtime sessions with content of interest to our membership, educational content, and we expect to have between 15 and 20 quick bite sessions during the course of the year. We're really thinking through a full curriculum for food venture entrepreneurs and middle market managers. So welcome to our first session on working capital financing for emerging food brands. The reason we led with this topic is that many of our members, many of the companies in our membership are looking for financing to help navigate the pandemic. Obviously, there's equity financing as one stream of money, of capital, and then there's bank lending or other forms of lending that many of our members are seeking. So we assembled a panel of experts in this field to talk amongst themselves and with you today. The format, before I introduce them or ask them to introduce themselves, is that we're going to be looking at this through three separate lenses. We're going to look at it through one lens of an early stage company, somewhere around $1 million in revenue. Their needs and their opportunities will be different from the next stage, which will be companies maybe in the $10 million range, not exactly, but kind of an emerging growth company, or less in that range. And then the third tier will be more established brands, 50 million in revenue up. And we've asked each of the panelists to kind of take the lead on as the lens into those specific markets, and we'll have a conversation that will be a survey, really, of the opportunities and the tools and the challenges in this area. So think of it as a 101 kind of orientation course, and during the rest of the calendar year, when we have other Quick Bite programs, we'll do deeper dives in some aspects of this topic. So we're going to have about 30 minutes of a conversation. Then we'll pivot to a Q&A. There is a Q&A function on your screen. Please send us your questions in advance of the Q&A, and we'll tee them up for the panelists to address. So with that, let me ask the panelists to introduce themselves, tell us a little bit about their backgrounds, the firms they work with, and their corner of the market. So Ben, would you like to start?
Sure, thanks, Don. So my name is Ben Brachot. I run a company called Dwight Funding. We're a non-bank lender to what we consider early stage and growth stage businesses. A very large portion of what we do is funding the natural food and beverage space. And so we have seen companies all the way from inception through exit. And we fund a portion of that journey along the way, but really fortunate to get to know like the founders that are in this space from, you know, when it's an idea until when they've sold their baby off to someone else in some cases. So very, very happy to be here. Thanks, Don.
Thanks, Ben. Kate, do you want to go next?
Thank you. So I'm Cate Bugbee. I work with a large commercial bank, Union Bank, and I'm in the Northern California market as their salesperson. I've been with Union Bank about 11 years and in the Bay Area for 20, doing roughly the same job for a couple of different large banks. And my corner of the market is really the later stage. So I'm working with companies that are more in the $50 million range who require working capital of $5 million or more. So I'm going to be addressing the kind of $50 million and above market. Thank you so much to Naturally Bay Area for asking me to be here, and I'm delighted. Thank you.
Thank you, Kate. And Andrew?
Sure. Thanks, Don, for inviting me. Such a pleasure to be here. I know all the good work that Naturally Bay Area does, and it's great to be a part of the panel. I'm kind of an unusual financer in the sense that my background is as a CPA, and I'm the former CFO of Numi Organic Tea based in Oakland. I happened upon Gerber Finance about 7 years ago now when I joined Numi. And I realized from the moment that I met them that it was a different kind of lender, very focused on supporting the client's growth and flexible when the need arises. Gerber was founded about 25 years ago in New York and has been in the natural product space for about 10 years. And then we've had a presence on the West Coast for a few years where I'm based in the Bay Area. We provide lines of credit between 250,000 and 25 million, so a fairly broad range that covers a lot of the people on the call. ABL, we're an ABL lender, which means that we loan based on the assets of the business, which typically include AR and inventory in the early stages. And as the company brand grows, we'll also lend on IP. Last year, we formalized what we call Naturally Gerber, which is our division that's in the natural products space. And I'm very excited to lead that from the West Coast. So thanks again for asking me to join.
Thank you, Andrew. And I also want to thank Lizzie Elliott, who's behind the curtain doing the logistics for us. She's a Naturally Bay Area staff member, and she's orchestrating this behind the screen. So the way we're going to approach this, again, is we've asked each of our panelists to look at this through the perspective of a certain size company. And so we have the $1 million revenue company, the 10 million, and the 50 million. And I encourage everybody who's listening to pay attention, not just to the category you're in now, but the category you may be in 3 years or 5 years, because this will give you a sense of how your funding or financing opportunities may change as you grow. And knowing what the next level of lender may expect is very important in your planning for this stage of growth that you're in. So we'll try to do this as kind of a round robin discussion where Andrew's going to be talking about the early stage company needs and opportunities, 1 million or so. Ben will be talking about the $10 million emerging growth company in terms of revenue and financing opportunities. And Kate will be talking about larger companies, larger brands, 50 million and plus. But we'll be going back and forth and having a conversation about this. We'll leave the last 10 minutes or so for Q&A, but please send your questions in as they occur to you, and we'll make sure we address them when we turn to the Q&A section. So let's start with the first question we wanted to address as part of this overview or survey. Let's talk about the kinds of credit facilities or lending programs that are available for companies in each of these respective tiers. So Andrew, if you want to talk about what might be available to an early stage company in the $1 million range and what the tools in the toolkit might be there.
Yeah, sure. Thanks, Don. A great way of framing it, by the way. It really is a journey, you know, from those early stages on through maturity, and those decisions that you make early on are really critical in terms of you know, kind of how that journey progresses. So, you know, the $1 million mark is a very exciting stage in a company's growth. One where you feel like you have a little bit of wind beneath your feet, and you're really getting some distribution. You're getting out there. People are you're starting to get traction in the market. You know, and you're still in a really creative stage in terms of how you grow and the business, and really all aspects of the business, from financing to marketing to sales, etc. So it's a great time, and it's a stage that I particularly love because there's so many ideas and optimism and innovation that happens at that particular point. With respect to financing in particular, I always like to say that, the cheapest source of money is your own. And if you can provide your own seed capital, that's going to be the cheapest way to do it. And then growing the business and reinvesting those proceeds. Next in line really is borrowing. And then last, but certainly not least, is equity investors. And it kind of goes in that order in terms of the expensiveness of doing it. And one of the hardest things for an entrepreneur to do is to ascertain what the right balance is, avoiding unnecessary dilution, and making the right decisions for your business as you grow. At Gerber Finance, we have clients that are able to avoid the cost of outside equity through exclusive use of debt and their reinvested earnings, and others that are backed by private equity. And those are certainly decision points that your company will have to make at all three of these stages of growth. At the $1 million mark in particular, there are a variety of alternative lenders for those folks who don't fit the traditional bank parameters. And in this internet age that we live in, it seems like there are more and more entrants every day. It's almost hard to keep up. The traditional ones are AR factors, where you're trying to monetize your accounts receivable and get advances on that. It's a very transaction-oriented process. Typically, you're going to get 70 to 90% of the funds up front, and then you're going to get charged anywhere from 1 to 3% for the first 30 days, and then a percentage after that. Purchase order financing is another way to do it. You have a big new distribution opportunity, and you need to fund the purchases of that inventory, and so you can get financing based on those purchase orders to fill those customer orders. Then kind of the area where I work in, I mean, I can't speak on the process for all of those with any great authority, but is really less transactional based and more relationship based. And our process, typically, it starts with a discussion of the company, what your goals are, what your needs are, getting to know each other and understanding if there's a fit. If there are, we typically ask for sort of initial documents, the financial statements, AR and inventory documents, et cetera. And then we would propose a term sheet if it meets our criteria. And then once that's signed, we go through due diligence and legal, and then we close. And that process can take anywhere from 4 to 6 weeks typically. It can be done faster. I heard a story this week of a deal that we did in 9 days, another deal that was done in 15 days. But it just really depends on the situation. COVID's changed the dynamic a little bit. The selection of which financing you're gonna choose is going to be based on your needs. I'd really encourage you to explore and ask lots of questions. Really try to focus on whether what you need right now is something more transactional or something more relational. Understand what the cost of that is, both interest and other costs, ancillary costs that may be part of it. What are the terms and conditions? Are there minimums? Are there guarantees? All of those types of questions. Most of us lenders, we're all here to help you. So don't hesitate to ask the hard questions about, what the loan terms are, et cetera. I would also recommend if finance is not your thing, you're in a very early stage company, oftentimes getting an outsourced CFO involved. Companies like Propeller and Stage Ones are excellent at this and have a lot of experience. They'll make sure that your accounting is up to par and is ready for that next stage in terms of getting financing. it's really important to put a good package together. It's no different than making a pitch to a retailer. You want to have an articulate story about who you are and what your needs are, and how the bank or other financial institution may help. And then finally, I would say, find a lender that can grow with you and be flexible, because this is a journey. I like to tell the story of Gerber. I joined just a year ago after 6 years as a client, but within the first a couple of months of closing, we had a client came back to us and asked for another $1 million. And we were able to say yes. So that flexibility to go along the journey with you is really important. Other cases where you have a big new distribution opportunity like Walmart, and you need some additional funding for that initial fill, you want to make sure that lender is going to provide that flexibility and the growth that to take you to the next level. So those would be my comments for now before we have any questions. Sure.
Thank you, Andrew. Thank you very much.
Yeah.
So Ben, now we're looking at the next tier of growth. Companies with 10 million or so of revenue probably have outside investment, maybe private equity investment. I assume the tools in the toolkit change a little bit for those companies, and what kind of financing is available to them. Do you want to help us walk through that?
Yeah, it's interesting. So I think Andrew did a great job of painting a picture of what's available early on. And, one thing that I would add to that is that there's a range of what's available to you. So ABL might not be available at that range, and factoring might not be available at that range. And like MCA might be, or a fintech might be something that is more readily available, though, I think those are sometimes like tough. Once you've grown a bit in terms of revenue to that $10 million range, there are both bank and non-bank options that become available, and there are pros and cons to each, I would say. But if we just talk about structure, on the bank side, there are traditional bank lines of credit, and then there are asset-based lines of credit that are available. And then on the non-bank side, it's going to be traditionally like non-bank asset-based lending. So it's backed by your receivables and backed by your inventory. The trade-off, to oversimplify completely, because I think there are phenomenal banks in this space, and I think there are phenomenal non-bank lenders in this space, are banks are typically going to be a little bit cheaper and may have some sort of covenants, and non-banks would be a little bit more expensive, maybe a little bit more flexible in availability or stage that they're able to get involved in. It's a gross oversimplification, but it's how I tend to think of that world and making that decision between banks and non-banks. The other options that are out there that have popped up in the last couple of years that you may come across from time to time are some form of revenue-based financing or venture debt. And I think that is a result of private equity and venture capital entering into our space in a major way, and backing young brands significantly and continuing to support them through their life cycle. And so there are some venture debt options or revenue-based financing or term loans that have come in, and those could either come in to replace an asset-based line of credit, or they could come in alongside an asset-based line of credit. We have seen those more and more available to what we would call growth stage, a $10 million range company.
Thank you, Ben. And Cate, looking at it from a commercial bank perspective, larger company and different kinds of instruments and lending facilities, what's the headlines there?
Oh, I mean, first, I think Ben and Andrew did an awesome job kind of describing the different types of lines that might be available. But because this is really focused on working capital, I think you should really think about the life cycle of your working capital and figure out ways to extend your payables and to compress your receivables. And there are definitely some other ways. I mean, obviously there's AR financing, there's ABL lines, there's a traditional cash flow line and things like that. But there are other bank products that are available, like commercial card, for instance. So put all of your payables onto a commercial card to just extend that working capital another few days. And there are other tools also to get in your receivables a few more days earlier. And we have multiple products that sort of satisfy that and to help your churn a little bit more so that you have to borrow less. So I think that's like really the only thing I can add onto the existing bank talk.
That's great, Cate. So now let's move to the topic of the underwriting process, which is really for the audience, the application and evaluation process. And I assume each of these loans at different levels of company growth and size are different. But the twist I'd like to provide here is that as kind of a coaching or teachable moment is that I'd like for each of you to talk about in the underwriting process, what do you or the lender look for that may not be in a mechanical formula, that where you can give our audience a sense of what would make them look stronger as a lending prospect or a borrower candidate in the, let's call it the interview process. So for the audience, this is an opportunity for you to understand in a job interview what the job interviewer is really looking for, when a college application admission interview, what the admissions interviewer is looking for. So maybe we'll go in reverse on that. So Cate, you want to talk about from a commercial bank's perspective, the kinds of factors they're considering in addition to the hard metrics?
Yes. So the first thing that we would look for is obviously historical financials and a budget, meaning what your financials are planned to look like for the term of the loan. So if you're looking for an equipment finance and it's 5 years, we want to see a 5-year program for your budget. And when we're looking at historical financials, I think the quality of the financial statements starts to become like pretty important when you're borrowing $5 million and more. So typically at say $5 million to $10 million, we're looking at a reviewed level statement. And over $10 million, we're really looking at a CPA audit. And so when I'm looking at financials, the very first thing I do is I look at the auditor's opinion letter and I make sure that this company is not a going concern and that everything is accordance to GAAP. And if not, then we have to dial in what's not according to GAAP. The other thing I look at in financials, obviously balance sheet is always the first thing that you look at. I'm looking at the balance sheet leverage. So your debt to equity ratio, which we never, I wouldn't say never, but most of the time we don't want to see it over 6 times debt to equity. I'm also looking at the AR, the receivables, and the inventory to see if the amount of line that you're asking for is conducive to the assets that you really kind of have backing it up. So these guys will tell you that a bank traditionally is like 50% on inventory advance rate and about 80% on AR, just as a blanket. The other thing that I look at is obviously your income statement and if you're profitable. If you're profitable, then fantastic. Let's go to the next level. We want to make sure that you have enough money to service the debt that we are going to provide. And we also ask for AR, inventory, and AP reports. And the things that we look at on there is on AR, we want to make sure that you have no significant customer concentrations. And if you do, then we need to address that up front. We need to make sure that your inventory is not stale or sitting around for too long and you're not turning the inventory. And of course, on the payables, we want to make sure, number one, that you're paying your suppliers, but also that you don't have a supplier concentration. Those are kind of like the credit things that we look at on those reports, but there's also a flip side to it. We may have relationships with your suppliers or your customers, or we may be able to, and that helps, we might be able to introduce you to a new customer, and we may be able to introduce you to a new supplier if you have concentrations in either one of those spots. Those would be the first things that I would look at during an interview process to sort of get to the next level. Of course, the history of the company is super important to us. The relationship side, incredibly important. I'm sure Andrew and Ben are both going to say the exact same thing about relationship and being able to take a company from a smaller stage and helping them grow and just helping them with their goals, their budget, get them to their budget.
Great. Thanks, Kate.
Thank you.
And Ben, your thoughts at the 10 million size company, also, what intangibles factor in, and does the investor base play a role? Who's invested in the company and how you look at it?
Yeah, absolutely. So most good lenders look at the same thing, but what we would do at the $10 million size that's a little bit different than what Kate just described is we would just rearrange the order a bit. And I'll talk about like a couple of the nuances that you might hear in a credit committee meeting so that you could prep for it as you're thinking about presenting in front of a lender. At a $10 million mark, and they're showing projections that may have them at like 25 million next year. Historical financials become a little bit less important because what happened in the last 12 to 18 months may not be representative of what the next 12 to 18 months look like. And so we tend to rearrange the order that we're looking at things and say management first, right? So who is management? What does their bench look like? And their bench could also include their investor base. Who are the people around the table and what's their ability to execute on that. So we are looking at that, execute on that plan. We are looking at that in detail and just trying to understand who it is that we would be supporting. And that's kind of the first mark for us always. The second thing that we look at is the collateral and the underlying collateral. And here's where I'll give you like a little bit of inside baseball, things that you can do to tweak and make it look a little bit better. So how the receivables are presented to us matters. How the inventory is presented to us matters because it's indicative of what internal controls you might have at your company. And so if we take your AR aging report and we spread it and we're seeing, let's say 30% of your receivables in that over 90 bucket, there could be a very good reason for that. You could be negotiating chargebacks with some of your suppliers. There could be a lost check out there. But regardless, you want to think about presenting it in such a way to the lender where you've already thought through and anticipated their questions, and you can maybe speak to the top 5 or 6 over 90 accounts. It shows a level of preparedness that you're on top of your receivables, you're on top of the underlying collateral that the lender would potentially lend on. Same thing goes with inventory reporting. We would want to see that the inventory is broken down in a way that is comprehensible. If expiration dates are a concern, we want to see that you're tracking lot codes and that you're tracking expiration dates, that you don't have oversupply in any area, or if you do, you can speak to it, and that you don't have expiring products. And again, if you do, you can speak to it. And then the last thing, so if it's management, collateral, the last thing that we look at is financial performance. And at the $10 million mark, we might not necessarily need to see audited financials per se. So you maybe bought yourself a year or two before you have to go spend the money on that. But we do want to see that the model is thoughtful, that it's detailed. Typically, we don't really want to see that summary model because the detailed model will tell us a lot more about what level of preparation went into preparing the financials. And Andrew brought up a great point earlier, which is that at a $10 million mark, you might not have a full-time CFO yet. And that's okay. That's not really going to count against you. There are amazing groups out there that provide outsourced CFO work that could help you put that that financial statement together, like your chart of accounts together, and your financial model.
Great, thank you. And Andrew, from your corner of the room here, I think you're on mute, Andrew.
Sorry about that. It's one of those wire trips that we have this day and age. Cate and Ben have done a fabulous job of really kind of laying the groundwork there. I would say what I would add at the $1 million level is that you're almost certainly making losses, right? And so the question comes up: do you have enough equity in the business? Do you understand the risks of the business? How well are you managing the cost, both of the promotional cost has kind of been referred to, but also your general expenses? What is your forecast? What does your plan look like? Do you understand the risk associated with those plans? Have you thought through what the various, particularly this sort of COVID world that we're in, where it's harder for younger companies that are innovative to sort of get out there and get the product on shelf, and even if it's on shelf, getting the traction that you need. So have you thought through all those things? And then I would say what's really, really critical is kind of that intellectual directness with the lender. You don't want to get yourself over the head in terms of promising too much. They're going to appreciate a direct and sober approach. Obviously, you want to grow your company, and we want to see that growth pattern, but also understanding what happens if that doesn't come through. So, we always say that we really believe in directness and forthrightness at Gerber, because it makes for a stronger long-term relationship if both sides can really help each other and explain to the other what's going on and understand their issues and concerns. So don't be afraid to be direct. Don't hide anything under the mattress. It'll come out eventually anyway. It is a journey, and you want to make sure you have the right fit with the right lender. That's all.
Thanks, Andrew. So I'm checking the Q&A board. We don't have questions yet, so I'm going to keep going until we do. We have plenty of other quick topics we want to try to address in the last 10 minutes. If you have a question, please post it and we'll turn to it. But in the last 10 minutes, let's hit a couple of maybe smaller topics. Let's talk about how you choose a lender from the category that you're in. So, Andrew, you're a $1 million company and you're doing really well, and you can choose. Just like the lender gets to choose, many cases, or hopefully many cases, the borrower gets to choose. As a borrower, what would you be looking for in a lender?
As a borrower, what would I look for? How well does my lender understand me and my business? How flexible are they going to be with growing through to the next phase? As kind of I mentioned earlier, are they going to be there for me in the good times and the bad times, or is it only the good times? What am I really signing up for here? Does the lender, we start with Gerber with from the perspective of how do we say yes, not how do we say no. And sometimes we have to stretch to get to yes, and occasionally we have to say no. But we want to be there for the client, and so you want to make sure that the lender that you sign up with is going to be there for you. I find oftentimes too, there's an intense focus on the interest rate, which is really important. Don't get me wrong, but it needs to be considered in the context of other options, debt, but also what the cost of equity is. Sometimes as we said at the outset, the cost of equity is going to be higher. It's just that the cash flow associated with it is different, and the dilution that you're potentially you're giving as an equity holder, as a founder, is going to be different. So you need to be thinking about that, kind of really from the outset, because you're at a stage in growth, and as you keep growing, you want to make sure that you've thought through what your exit strategy is if you want to exit, or if you're in it for the long term, kind of where you're headed from that perspective.
Okay. And Ben, do you want to jump in next in terms of what you'd be looking for as a borrower from a lender or of a lender? I think you're on mute, Ben.
Sorry, that was my turn. At the $10 million mark, you probably have some great investors and a great board and advisors. And my like number one piece of advice is the lender is going to do their due diligence. Like Andrew said, like don't hide anything under the mattress, but use that courting period, whether it's when you're collecting term sheets or when you're actually in due diligence with the lender that you chose. Use that opportunity to diligence the lender as well. And I think asking for references is fine. Everyone always leads with their best references, but I think asking like turning to your advisors and asking them what their experience has been is another way to get a little bit of social proof that this lender does understand you and that they are your people, and to Andrew's point earlier, can stand by you through the good times and inevitable like bumps in the road, because every company at this size has some bump in the road.
Thanks, Ben. And Cate, from your perspective, if you had a $50 million company and you were looking for a commercial or institutional lender, what are the factors you'd be looking at, maybe the top 2 or 3?
Yeah, first of all, I could listen to Andrew and Ben all day long talk, so they've been doing awesome. And the only thing I would add is it's relationship based. Do you love the relationship manager that you're going to be dealing with when you need that extra few $1 million, or when you're going to buy a new piece of equipment, et cetera? Do they care about you? And I think that's a really big thing. And do they have like intellectual curiosity about your business? How well do they know you? Are they going into the back room and seeing what everybody is doing and really to understand your business? Just to Andrew's point, totally. I think that's a big factor. Obviously, rates are a big factor too. I mean, I'm always competing on rates, it seems like, but at the end of the day, I think that people are willing to pay an extra 25 basis points for a really solid relationship. And that's what we focus on. That's what we sell, is relationships.
Terrific. Thanks, Cate. So I'm going to have one brief question that's from my list now, and then we have a couple that have come in from the Q&A audience function. So we'll try to keep these parts of the conversation brief. Personal guarantees required in many loans for early stage companies. It's a necessary evil. Talk to us about when they burn off, when you can approach a lender and say, or pre-negotiate with a lender, when I do X, Y, and Z, I want the personal guarantee to go away. Ben, do you want to start that conversation?
Sure. So personal guarantees make a lot of people uncomfortable I think for good reason. For the lender, it's there because it gives them a little bit more comfort that the founder is not going to walk away from the collateral that they put up or walk away from the company. But I think philosophically, Dwight doesn't believe in personal guarantees because in our minds, in that hierarchy that we were talking about, collateral is so high up there that if we're not comfortable with the underlying collateral, we're not comfortable with the underlying business, there's no personal guarantee that an individual is going to give us that could get us across that finish line. We would rather politely say no and point them in the right direction. To answer your question, though, more directly, Don, I think that a personal guarantee should burn off in a couple of situations. One, if the company is consistently profitable and the collateral has consistently performed, And it's difficult to define what consistent is, whether that's over the course of a year or 2 years. I think that's one instance where you could request of your lender, if you've already signed up for a personal guarantee, to perhaps consider removing it. The other situation is when you go out and raise a round of equity. And that's really for twofold. One, you can now tell a slightly different story to your lender, which is that we have support in the form of investors, whether they're institutional or non-institutional, that can potentially help us out if we ever get into trouble. The other story that you're telling, which is I think totally valid, is that you're no longer 100% owner of the business. You've been diluted down, and providing a personal guarantee at that point for the company, even though you might not own the majority of the company, or 100% of the company, might be inappropriate. So those are both instances where I would say that there could be a conversation with the lender if there's already a personal guarantee involved.
And Cate, any quick thoughts on that?
I would only add that if the balance sheet leverage is quite high because the owners are taking money out, too much money out, then sometimes we'll ask for a personal guarantee up front and look to take it off over time. The other thing is, as I think Ben is mentioning, you go after the assets of the company if you're in a default situation, or a personal or a person. So you don't go after both. So most likely you're going to be going after the assets of the company no matter what. And it's more of it's a head thing versus a real tangible thing that banks go after. We never ever would like to go after a person to get back loaned money. So.
Great, thanks, Cate. So we do have a few questions in from the Q&A. I think we'll just have time to get to one. I apologize for that, and we'll try to circle back to the others with those questions outside this program. But Andrew, would you take a swing at the question of how does lending criteria change for direct-to-consumer brands that are selling direct-to-consumer? Is there any kind of quick insight we can get and give companies in that channel?
Once again, that's a great question, and it's something that we discuss frequently at Gerber. It's very topical. The market's changing very rapidly. COVID has accelerated the trend that was already quite strong to e-commerce, and in particular to DTC. And our view is that the industry is going to have to change to sort of keep up. We've typically looked at AR and led with AR, and then followed with inventory and other things. And that dynamic gets turned around with a DTC business where your window of receivable is quite small. There are things that companies can do to improve the availability there in terms of integrating their platforms with the Amazons of the world, or the PayPals and etc. That can help increase the transparency of what's out there in terms of both receivables and sales. There are different models, and we tend to kind of use a trailing 12-month approach in terms of understanding the business and the trends, and then look very closely at those last 3 months or the last 6 months, and at the forecast and what's happening overall in the category and with the company, and what the risk is associated with the individual one. It's hard to be kind of generic about it, but the more that you understand your sales, both your sales history and your sales forecast in terms of that DTC business, the easier it is to to make an argument that lenders should lend against it. But it is a challenging area for us because we're collateral-based lenders, and so the metrics need to evolve.
Right. Okay, thank you, Andrew. And unfortunately, everyone, we've run out of time here. For the audience, please let us know what topics you'd like us to pursue in subsequent quick bite sessions. We want to be very responsive to what you want to learn, and so we're looking for feedback from you in this area as well as others. And we'll make the email contacts for each of our panelists available so you can continue to outreach to them if you have specific questions about your business. And I want to thank our three panelists, Cate and Ben and Andrew. I thought you did a fantastic job covering a broad landscape here in a very concrete way. So thank you for that.
Thank you.
Okay.
Thanks.
Thank you for having us.
Be well, everyone.